So do you think we're getting 75 basis points today? And how will the market react?
I think markets have already priced in 75 if you look at interest rate futures. So I would say that makes a lot of sense because the Fed doesn't necessarily want to surprise markets. And I think that I'd agree with those who say that a move like today is probably better for risk assets, only because it really narrows the perception about how far the Fed is behind. You know, a simple way to look at it is the spread between the 2-year and Fed funds, which Jeff Gundlach has mentioned many times. And it's at the highest level since May 94 today. But after the hike, this brings it down to levels that were actually lower than we were around April this year. So I think in some ways, you know, investors could actually start to feel better that the Fed isn't as behind, fewer sort of upside surprises. And of course, the data has to start cooperating going forward.
But they're going to be really aggressive going forward. Don't you agree with that? You saw Fed funds futures, what Leisman was talking about, where rates could really be going. The market's just going to be just fine in that scenario. I think people have a hard time believing that it is.
Yeah, there's I would say that nobody can say the macros is super clear right now. I think it's been helpful to see some of the slowing and the job cuts, because that just shows the current hikes and the current tight financial conditions are slowing the economy. And I think, of course, the unknown is what happens with gasoline, because that is really driving people's perceptions about CPI. But on the flip side, I'd agree with what Kevin and Jim have been saying. You know, there's a real test happening to corporate America here. You know, in the pandemic, people expected earnings to collapse, but companies slashed costs and managed through that well. And I think that really earned them a view that they're kind of much more durable than people expected. And now I think investors are also assuming that companies are going to get massacred in this current environment. But if they're going to navigate through this better than expected and earnings hold up better, then we're talking about a situation where investors are risk off. The Fed isn't necessarily going to shock markets with further surprises. So even if rates, you know, if the Fed hikes from here, a lot of that's already priced into future interest rates. So there's fewer surprises to discount rate and what you think risk premia should do. And so I think stocks could do a lot better.
John Najarian, I want your counterpoint, I suppose, because you're extremely negative, it sounds to me, against what is Farmer Jim and Kevin O'Leary and Tom Lee's optimism.
Yeah, I mean, I'm an optimistic guy overall, Scott, but I'm also a realist, and I'd love to hear Tom's opinion on. Tom, you heard today that Ford had significantly higher delinquencies. Granted, that's coming from a low rate. I get it. But that's only going to be accelerating for the next year. That's going to go over to credit card debt. It's going to go over to mortgages. We all know how this snowballs. So how can I be as optimistic as you, Tom, if I know that consumers that are 70% of the economy are going to be strapped? They're not going to be able to trade, you know, as far as there'll be more people renting because home affordability is going to be going down. Meeting that mortgage payment is going to be a lot tougher unless Biden actually did something about an energy policy, which he has only done a negative energy policy so far. I mean, you already said the price that will be paid to transport items for people. I mean, increasing interest rates doesn't bring food prices down, doesn't bring gasoline prices down. It just doesn't. You can impact other things, right, but those two will not be brought down because people have to eat and they've got to get somewhere.
Strapped consumer, right? If not now, it's coming.
Yeah, there's this is sort of the peculiar, that would be peculiarly positive actually for equities, John. And it's not because I want people to lose jobs and not repay their loans. These are obviously, you know, bad signs, but in the aggregate, it actually has two effects. One is it's really going to slow the perception about inflation, because if you've got delinquencies and repossessions and housing slowing, well, that just kills two stalwarts of the inflation narrative. You know, one is housing and owner's equivalent rent in the future, and second is goods pricing. And it also weakens the job market. And as you know, the Fed is really concerned about how tight the job market is. So I think if what's happening on the margin actually supports the idea of a soft landing. And if it's a soft landing, the Fed doesn't have to go as far. That's a very minority view right now because I think people are really concerned about inflation. But it's even if you look at things like the Cleveland Inflation Tracker, core inflation is cooling, not maybe fast enough for the Fed, but there are signs of cooling. And if we add all these things, it means core inflation could drift lower. And that's probably the best news for risk assets.
I mean, and they're not only worried about inflation as to why they think there's not going to be a soft landing. It's because history suggests that the Fed can't pull it off. And maybe that's the overwhelming factor in the reason why there is a level of pessimism that the Fed can do what the market suggests is going to happen by Fed funds futures, and then somehow they're also going to have the incredible ability to avoid a recession. We will see. And Tom, I know we'll talk to you multiple times in the weeks and months ahead. I got to run. I'm tight on time, but we'll see what happens this afternoon. We'll see you soon. Coming up, we do have many moves from the investment committee to get to today. Their latest buys and sells are coming up next.